welcome to my YouTube channel where I'll be evaluating JSE companies. One of my New Year's resolutions for 2025, wow, 2026 is to start investing. And then one of the legends says, if you want to start investing, start with the A's. The legend is Warren Buffett, by the way. So I'm going to be starting with the first company on JSE and then take it from there. The first company is 4sight. As you see, this is a simple valuation of 4sight. Let's go. At first I started by looking at what does 4sight do, right? And then if you look at it, what they do is that they help businesses and organizations digitally transform using advanced technology. They build and sell tech solutions that help companies modernize their operations, becoming more automated and use data intelligence. It works with AI, cloud computing, data analytics, Internet of Things, and automation, and the fourth industrial resolution technologies. Basically, guys, what it does it's a consulting company which uses tech to help its customers work smarter, faster, and more efficient, right? And then I looked at what are their revenue streams, like how do they make money. Firstly, they sell and they license software, which is something that I like. If you can see it in bold, I like this because of its recurring revenue. I want to invest in companies which have recurring revenue, because I can predict that, okay, next year they're going to have another 10 million, another 20 million, you know what I mean? It's not a guessing game. And then they do professional services, which is the consulting, implementing, and system development. Not really my favorite, because of like, this can fluctuate. This year you can have a lot of consulting work, next year you don't. I mean, not for me. They do support and maintenance. I like this part, because maintenance again is recurring. Every year, after 2 years. Also predictable. If you look at it, I like predictable revenue, right? I want to know what's going to happen in the future, or at least eliminate uncertainty, right? Also, they have channel partners where they sell, distribute, and support a solution on behalf of international software vendors, including Microsoft. They sell technology and IP solutions. Also, I looked at what's their future plan. The future plan involves using AI tech solutions, buying companies aligned with its goal, and expanding beyond SA. I like the fact that they're expanding beyond SA also, meaning that if there's some issues or South Africa's economy is going through some difficult times, they can be making money outside South Africa, right? And they want to increase their recurring revenue to 70-30 weeks. Another beautiful thing, they also like to see recurring revenue and less product revenue. They want the stability like I do, right? And that's beautiful. Now let's look at the income statement. So the income statement is for a period of 5 years. Look at the revenue, guys. Like doubled from 500 to like a million. There's something I like. I like to see that. It's a beautiful figure. The cost of sales increased by mainly the same percentage, meaning the gross profit increased by the same percentage. Yeah, and they can improve the cost of sales. Like, what you want to see revenue increase, but cost is stable, right? Increase that gross margin percentage. That would be beautiful, but I think they're working on that, I guess. Operating expenses was 300, is still 300. This is beautiful to see. Which meant that operating profit increased like from 17 to 49, which is like more than doubled. That's a beautiful sight to see. Also, profit before tax, again, I mean, you can say double from 20 to 39, which is almost 40. Again, income statement looks beautiful. Over the five years, the company has been growing, but if I look at last year and this year, the growth is not that much. But I guess last year has 14 months, I guess, so you can take that into account. Now, balance sheet side, I'm looking at the total asset. Total asset again increased, which is something nice to see. You see PPE increase, goodwill is the same, meaning they haven't bought that much companies, or they're buying companies at an unfavorable position. Intangible asset is the same. deferred tax asset increased. This is nice. Future tax savings. Investment in associate increase. Could be that the associates they have their value increased, or they bought more, didn't really take that much. Trade and other receivable increased. I don't know if I like this, because of it means now Sarah, you make more money, or people are not paying you. I hope it's the fact that they make no more money, but I'd rather see this decrease and cash increase. Let's speaking about cash. Let's see cash. See, beautiful, from 66 to 100. I like that. Cash increased. Cash is king, guys. Current asset is also kind of doubled in a way, but it's a small number compared to the overall numbers. But what I'm impressed of here is the cash. They're having more money, meaning that they can fund their business with cash and not debt. I like that. Let's look at the liability, guys. Other financial liabilities, non-current, decreased. See, beautiful. They're paying off their liabilities. Deferred tax also increased. Trade and other payable increased. I like this one because of it saying that instead of us paying our suppliers, we are holding back the money, we are expanding our terms of payment, and then we'll pay them in the future, but for now we're going to use our money to make more money. Or it could be that they are getting more expenses. I hope that's not the reason. But yeah. Again, other financial liabilities, they're paying this big liability. I wonder what this liability relates to, but they're paying it off. And other current liabilities also decreasing. I like to see the fact that they're paying their liabilities. And I want to look at current liabilities. 167 current asset. This is beautiful. You see, their current asset cover their current liabilities. You want to see that in the company. Meaning I would have loved it even more if their cash could cover the current liability, but it's close enough. This is beautiful, guys. Beautiful balance sheet, beautiful income statement. Let's move on to some key ratios. Now, firstly, let's look at the cash from operating activities. But I don't like about the cash is that it's going up and down. 48, 4, 42, 6. Like, it fluctuates. I would have preferred to see it more stable. 10, 15, 20, 25. You know what I mean? So I like predictable companies. So not a plus for me. Debt to equity ratio. It's a little bit high, but yeah, it's okay. I mean, it's not that bad. Current ratio. Current ratio is beautiful. Like I said, guys, their current asset can cover their liabilities, so I like to see that. It's a beautiful one. They see our profitability ratios. We saw operating profit again is more than doubled. Let's see there. I like to see this part: return on equity and return on asset. Return on equity increasing, but both of these ratios I like to see them high, about 15 to 20%. A little bit low for me, but maybe it's the industry. Let's move on. Okay, I went to ChatGPT and just asked for the following ratios, and then I asked it to compare to the industry average. Now the EV ratio, it says it has a 4.5. The average is between 10 and 11 for the industry, which is a little bit low. But what you're gonna do, again, the equity ratio normally is 0.3 to 0.5. It's 0.55, not within the industry average. PE ratio is shiny. So it is a PE ratio of 8, and the average is normally 1. Guys, this is but it couldn't find South Africa specific, so it went global. It might be the Magnificent 7 destroying this average, but it's beautiful to see. Yeah, I like companies with PE ratio below 10 on my side, so this is a plus. Again, return on equity, I prefer to have 15 to 20%. It has 11. I guess what you're gonna do. And these two, I'm just gonna leave it because of the vary between firms. You can't really compare them to other companies. Now, my final thing that I do, and which basically determines whether I want to invest, is discounted cash flow. calculation. So firstly, I asked ChatGPT to give me the cash flows for the company for the past 5 years. Again, they are not stable, so I just took the latest one, which is 27, and then I made 28 just to run it off. To do the calculation, you need the free cash flow, which is 28. I just showed you in the other page. Growth rate, I'm keeping it low, 3%. Discount rate is 10%. Basically, it's 8%, which is the South African long-term 10-year rate, plus another 2% just for the margin. And then you need the price to free cash flow, which is equals to your market value of the company divided by the free cash flow. The market value of the company is for 1 million, so divided by the cash flow of 28 million, you have a price to free cash flow of 14. Let's get into the calc now. So again, this is a very basic valuation, right? There's not much assumptions which went into it. It's just simple stuff, because again, I'm a beginner. Free cash flow, again, guys, the current year one is 28, and then if you do 3% every year, it increases. By year 10 you have 38. Terminal value is basically the year 10 one times our price to free cash flow, which gives you 539. And then you discount this column here is discounting your free cash flow for each year. 29 discounted to the current year is 26 using the 10% discount rate. Like if you add all of those things up, it says the value of the company should be 406. Now the market cap, like we said before, it's 401, which gives you like a 1% margin of safety. Yeah, that's not for me. I would prefer a bigger, like a 20% margin of safety, like 15% margin of safety, because of my calculation is very basic. It's just the cash flows, and then this part is discounting them to the current year, and then I'm adding all the cash flows until the terminal value, or plus the terminal value, to get my, what I say is my true value of the company, which is 406. So yeah, very small margin of safety, so this is a no for me. I want to see a bigger margin of safety, but I like the income statement and balance sheet, and I hope the company really does well. Guys, tell me again what I missed, what formulas I should also be looking at, what I should include when I'm looking at a company. I'm learning, so help me as I go. Thanks guys, bye.